welcome to each one of you. This is Rahul Sharma here from JM Financial. The idea is to share some of the learnings that we've had over the past few days and weeks and the view that we hold for the market going ahead from here. So, we've been through a tough time for sure. Over the last 6 months, we've seen all kinds of a market. We've seen primarily a bear market, but in between there have been instances where we've seen sharp bounce backs as well. And the question in everybody's mind is where could be the next big opportunity in the market in terms of the biggest upside potential, or where is that area of the market which could be a hiding ground if the volatility comes back again. So we would like to take you through this in a pictorial journey where we have to show you some of the charts that we've collated, some of the view that we hold in the market. And for that, I'll just start sharing my screen. Perfect. So, we've seen sky high valuations. We've seen 2 negative quarters, a lot of global uncertainty, and the tariffs which have ensured that Nifty have remained in the grip of bears over the last 6 months. So it all started with China being relatively better placed way back in October last year. Post that, we had the quarterly numbers which disappointed, and then the series of events that have happened after that. Now, both portfolios and confidence level of investors have taken a hit in this period, as pessimism and fear both have peaked around few days back. We feel that fast forward today, there are some green shoots. There are some reversals, signs of reversals that are happening in the market as we speak, and we are of the belief that over the next 6 to 12 months, the road ahead may not be as bumpy, as turbulent as it has been over the past 6 months. So without further ado, let us take you through the best setups that are there in the market and where exactly are we positioned in terms of performance over the last few months. So this is a comparison of all the asset classes. So if you see, it has been natural gas, Bitcoin, gold. These have been the top performers over this period. This data has been taken since mid of October till date. So in this entire period, it is clearly evident that gold as a major commodity has dominated the space, followed by natural gas and Bitcoin. Whereas there have been sharp cuts in Brent oil, in zinc. We've seen correction happening in some of the metals like aluminium, and even silver has underperformed this period in spite of all the momentum and big move that we saw in the earlier part of the previous rally. So where does that put equity markets into? So if we take a texture of how our domestic markets are placed, so in this same period from August to September last year, it has been one index which has clearly led this entire period. It has been CNX Finance or Fin Nifty, like we all know, followed by private banks and Bank Nifty. Defense has also been one space which has done well. But apart from these top 3-4 sectors, most of the other sectors have ended this period in the red, primarily led by media, energy, oil and gas, realty, auto, and public sector enterprises, followed by Nifty IT. So the dent has been quite severe and especially broad-based. So earlier, there were some grounds in the market, but in the last 6 months, what we've seen is the slow, gradual churn, which eventually became very, very fierce towards the end of it, when the tariff war was at its peak. And every day we were seeing sharp cuts in the US markets, which essentially was lacking in this entire 6-month period. So now that this panic throwaway sell-offs have happened, we feel that over the next few months things should relatively get better from here. Now, what are the factors that will impact the Nifty the most? So the factors are obviously the global markets. So we feel that the global volatility may be over for the time being, but the global correction is not done yet. So US markets may continue their downward journey going from here, and bounce backs could get sold off into. Tariff wars have taken a pause for the time being for sure, but this is one area where markets may remain a bit skeptical, but may not be as frightened as they were a few days back. So I like it is said, lightning does not strike at the same place, same way. Markets may not react the same way to the same fear, which is the tariff war, and this may eventually start becoming a non-event, as we've seen over the last few days. Now, amidst all this, the relative positioning of Nifty or the relative positioning of India has been fantastic. So because we were in a bear market way before US markets started correcting, we haven't really fallen as much as some of the global counterparts, let's say China or US markets or even European markets for that matter. So the correction has been relatively shallow because of that. And secondly, there are a lot of factors that are very, very positive for our macro sentiment, macro environment. So we see Brent oil, which is comfortably trading below $70 per barrel. That should bode well for our markets. Then inflation is pretty much under control. There is a monsoon forecast that this year the monsoons are expected to be in line with the averages. So no real pain or panic coming in from the weather side as well. And interest rates, like we all know, we've already started seeing interest rate cuts, and the market should now focus onto the domestic numbers. So the domestic numbers, if they happen to be slightly better than the last 2 quarters averages, I think the markets will take that positively, and we may see the Nifty extending its gains. But having said that, even if the numbers do not turn out to be higher than expectations, markets have already discounted that, and market may not fall for the same reason again. Now, technically speaking, there is a falling wedge pattern that is formed in the Nifty. So this is a entire period from the September peak until the recent low that we've seen below the 22,000 mark in the early part of April. So this is a falling wedge that has been formed on the daily charts of Nifty. And if you can see, relatively we've not broken the election day outcome low. This entire bull market began in October 2023, and from October 23 all the way up to September 24 is when this market peaked. And now, after 6 months of a bear market, we feel that the chances are there, the probability is very high that the market has begun its base formation and a proper bull market can emerge from here. Now, whether that happens immediately or whether it happens after a period of time, that is something that we have to evaluate. So what we've done is we prepared case scenarios. As you can see, case 1 is Nifty, the current rally extends, Nifty spends some time and eventually sees the breakout in case 1 and goes all the way up to 25,000 in a very short span of time. So this is case 1. Case 2 is we revisit the 22,000 bottom, maybe create a newer low around the 21,600 mark, and then from there a structural rally begins from there. So according to the way global markets are set up, according to the way we are reading the situation, we feel unless and until the earnings bring in a surprise, the probability of case 2 happening is very high. And if case 2 happens, there could be another opportunity for investors to lap onto their favorite stocks, lap onto quality setups, quality businesses, and play for the next leg of rally, which may eventually happen possibly in the month of May or June. So net, we feel that the downside is limited. 22,000 may not be broken in a meaningful way going ahead from here. It may be broken in intraday basis. It may get broken, or we may create a newer low around the 21,600 mark. But the risk reward is very, very favorable around the 22,000 area. So if Nifty comes down to 22,000, this is a good time, as it may be the third attempt to form to kind of break down from the current setup, and failing to do so, we feel that eventually markets should see a strong rebound, and then the rebound could very well take us beyond 25,000 and maybe towards a new all-time high in the next 12 months as well. So net, the view in short is we expect Nifty to do well from here. Whether it happens immediately or happens after a revisit to 20,000, only time will tell. But as per our readings, the chances of case 2 playing out remains relatively high. Now, which are the areas of the market which can give you a bang for your buck? So one sector clearly, as highlighted in the previous graph, has been a leader, which is the Fin Nifty space or the Nifty Financial Services. So this is the ratio chart that we've plotted. This is the monthly chart, so a very long-term data is placed over here. So this outperformance began began around 3 to 4 months back, and in the last 3 months we are seeing a vertical rally happening in the Nifty, and it has outperformed the Nifty by a big margin. We feel that there is more upside to be had in this, and this ratio could very well head towards the 1.2 area, which is the previous top, and around there we feel that the current rally could be maturing in the Nifty space. So any dips, if they happen in the short term, if they happen in the recent in the next leg of corrective down move, can be looked upon for entering into longs, and we feel that this is one area where there is still alpha to be created, there is still money to be made. Now, speaking of banks, so banks relatively have done well in this entire correction, and if you see this ratio chart, the lowest green arrow that we've marked is basically the COVID low. 2020-21 is the period where this low was formed, and post that it has only formed higher lows. So whether be it the low in 2022 or the low that happened in early 2025, which is the recent one, it has formed a double bottom around the two mark. So from a positioning perspective, banks continue to remain as outperformers, and you could very well increase your weights in your portfolios when it comes to banks and financials alike. So there are two spaces which account to about 35% of the Nifty weight. Again, a sector which does not get as impacted by what is happening in tariffs, what is happening globally. It has got a lot of focus on what is happening with the domestic economy, and with rate cuts and with the boost that we are seeing, especially on the consumption side. We feel that this is one sector which can continue to give the returns. Now, another sector which gave a multi-year breakout was the public sector enterprises. So if we talk of public sector enterprises, there was a decadal breakout that happened around 2 years back, around 18 to 24 months back. And this decadal breakout, saw a vertical rally. We saw all PSE stocks flying. In fact, this sector did so well that the Prime Minister, also commented twice in the Parliament regarding the performance of these stocks. But now, after these 6-7 months of correction, we feel that the time is right for this sector to sort of continue this previous rally. And in the next leg of rally, we feel that this sector can do really well. So if you have a 6 to 12 months perspective from here, PSE is another space which can see a continuation in the rally. And there is, these setups are decadal setups. So some of these stocks, after giving the big breakout that we saw in 2020-23, post that they've taken a pause, and this pause is actually an opportunity in disguise. As the correction has been done, the demand supply check has been sort of tested for the sector, and now we feel that there could be a big turnaround happening in this space. So we remain very bullish on the PSE space, followed by domestic consumption. So as we saw in the budget, there was a big boost given by the FM on the domestic consumption. More money in the pockets of Aam Aadmi. That translates into a increased spending, especially in the consumption space. And we feel that this is one sector which is very diversified. If you see this index, it's a thematic index, so very diversified play in itself, but with a lot of focus on what is happening domestically. So like I said again, we have to focus on sectors which are linked to domestic consumption, which are linked to the domestic economy, because these are the areas of the market which may not get as impacted even if there is a global turmoil. So this is the absolute chart of consumption index, and we feel that this sector is set for a reversal from here, and we could very well see this index heading towards the 13,200 mark over the next 12 months time frame. So this is one sector which should dominate the big moves going ahead into the rest of 2025. Now coming to one index which is the Junior Nifty. This index is is about to get promoted because what this index has enjoyed over a long time is high beta. So when it falls more than the Nifty. When it goes up even more than the Nifty. So historically it has enjoyed about 1.8 beta. What that means is if Nifty goes up 10%, the index junior Nifty may end up going around 18% higher. So what that means is, if the view goes right, there is big money that can be made in the junior Nifty, and one way to participate in this index is by buying the junior Bs ETF, which we have recommended multiple times over the past few weeks or past couple of months. So junior Nifty or junior Bs is a preferred play. As you can see on the charts, this is again a long-term chart. The RSI is about to see a breakout happening anytime soon, and when that happens, which also coincides with the breakout from the current setup that is there on the charts, as and when this breakout happens, we feel there is a quick upside to be had in this index. And as an investor and trader, we advise to stay invested in junior Nifty over the next medium term to long term, which is say 6 to 12 months time frame, and there is decent amount of money that can be made over here as well. So yes, everything comes with a caveat. Keep your stop losses. Risk management is very, very important, but we wanted to give you a picture in terms of how are we positioned on a relative scale. If markets have to do well from here, which are the pockets of the markets which can do well. So all the indexes, all the views that we've given, we advise to maintain a stop loss of 10% as of today's closing level, and we expect these indices to do well. Now coming to some of the baskets that we've recommended in the past. So we've recommended the top 7 PSE basket, which has done well. We've recommended the shopping list in March, a ready list of stocks which can be bought, which we advise to be bought in case the volatility increases due to the tariff wars, which has played out very well. And going ahead also, we feel that these baskets can play an important role. So in case you are not yet registered as JM Financial client, we would want you to have on board to be a part of the JM family, so that you can receive these ideas, you can receive these baskets, and make the most of the available opportunities in the market. So this is the view that we hold. We feel that the worst is behind us, especially in terms of volatility, and going ahead from here incrementally, we think markets should get better, and we expect steady performance from the Nifty over the next 3 to 6 month period, specifically coming out of this 6 month of a bear market. We are now opening the floor for Q&A.
Can we expect good turnaround post Q1?
Yeah, so this is a question which is on everybody's minds. The impact of the rate cut will eventually start coming down into the economy, and we should see things definitely improving from Q1 onwards. So the Q1 numbers probably should start from June onwards is where the numbers would start coming in, but the markets would start discounting them ahead of time, and we feel that the markets, because eventually it's a big discounting machine, probably some of the moves have already started. Seeing banks do very well, we are already seeing financials leading the market. So we feel that the numbers should definitely improve. The Q4 numbers should, even if they are slightly better than the expectations, that would be a positive surprise. And Q1 eventually sees a big turnaround in terms of the growth. That should bode well for the markets, and that will eventually lead to FIs also turning from net sellers to net buyers in the Indian equity space. So yes, the expectations are positive, and we feel that markets should start doing well, especially Q1 onwards.
Does golden cross analysis work?
Yeah, so golden crossover is a technical indicator where the two the long-term moving average and the say medium-term moving average. So long-term moving average is say 200-day moving average, and the medium-term moving average is say 50-day moving average. So when these averages cross each other, so for example, you see that the 50-day exponential moving average has crossed the 200-day moving average from below. So if there is a positive crossover, it is called the golden crossover, and golden crossovers are very reliable indicators historically. So this indicator has done very well. In the short term, it may not make you money, but if you have a holding period of about 3 months, generally this indicator has done very well over the past. And since it is a crossover of two big averages, it is advisable to not trade short term based on this crossover, rather have a positional medium term approach to trading when you take a call based on this indicator.
What is the proper entry and exit in options?
Yeah, so options, when it comes to trading options, you have to be like a sniper. The entry and exits are very, very important, especially the timing of these entry and exits. So the best time to be buying options is when you expect an absolute momentum to come into the stock or the index. Now, what does momentum mean? Momentum means the market's going up or down very quickly. The problem with buying options is when you buy options, you are swinging against the tide because theta is always working against you. Theta is basically the erosion in option premium when as time passes. So every day there would be an erosion in time value, erosion in the premium value, as even if everything else remains constant, theta is something that will take money out of your pocket. So the best thing to do is when you are buying options, look at breakout setups, look at high momentum setups where moves can be immediate, so that you can time your entries well, and at the same time, once your trade comes to into a profit, so let's have a number of say 20%. So if your premium goes into profit by 20%, always trail your stop losses, and on the upside also have an exit plan in place where every time say the premium goes up by 50% or it goes up by let's say 30, 40, 50%, you also book profits in a systematic way. So only then can options trading be successful, unless and until you have this discipline of entering and exiting as per the plan, and at the same time not going into excessive leverage. So always trade with whatever you have in hand. At the same time, divide it into at least 10 different iterations, so that even if the view goes wrong once, twice, or thrice, you still have about enough number of opportunities available at your hand. So divide your capital into multiple small pockets, and then trade options with proper risk management and proper planning.
If a big stock corrected 30 to 40% from its peak, then what condition do we have to watch to add it in our portfolio?
Yes, that's a very good question. In fact, there are a lot of stocks in this recent bear market which were big stocks but corrected very sharply. To name a few, some of the two-wheeler auto names saw sharp correction. We saw sharp correction, in a lot of mid caps as well, which were relatively bigger names, but the correction was very deep. Technically, what we look at is whenever these stocks get heavily oversold on the long-term charts. So in case the weekly RSI or even the daily RSI, if it goes below say 20, 25, 25 is like a very good number to have. So below 25 is the deep value level for stocks. Below 20 would be ideal. So a lot of IT names are in that category as we speak, because IT stocks have seen a vertical sell-off. So RSIs for these IT stocks are very, very oversold. And the thing with RSI is you have to give it time. So always look at buying these stocks when they get cheap, but give them enough time also for the entire thing to turn around. So this can be a good tool as a confirmation of your existing view that you may have on a particular stock, and whenever say a Nifty 50 stock or any of the big index stocks become that kind of an oversold, and post becoming oversold, if it spends some time like forming a base, the latest example can be IndusInd Bank. So IndusInd Bank saw a deep sell-off. Post that it saw some consolidation, and in this last 2 days the stock has been doing very well. So look out for these extremely oversold setups, but with some bit of consolidation, and post that you can take a trade for a reversal of any kind. So thank you so much once again, and have a good evening ahead.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.